So Kate, there would have been a lot of strategy around what sort of properties you would be recommending to people, what sort of properties investors would be coming to you saying, because Labor's going to win the election, which is what most people thought,
Yeah.
what sort of property do I buy to lock in the best sort of tax position or advantages? So you must have had a bit of, I guess, some strategy work on what you'd be recommending.
I love this question. I do, because I don't buy for tax benefit.
Yeah.
But I certainly help clients buy for a cash flow scenario that will work for them. And there's no doubt about it, on an established property, particularly down in Melbourne where we've got pretty dismal rental yields anyway, we really cherish the help that we get from the taxman, because it makes an enormous difference to being able to hold a property versus not getting that help and maybe ruling yourself out of owning a property like that. So I had to really think carefully about what sorts of assets I could target in the event that negative gearing isn't available, but still selecting an asset that will deliver good, strong capital growth, will attract the right tenant, won't cause any problems for the landlord in terms of being in a marketplace that's oversaturated. Let's use South Yarra apartments as an example. There's lots and lots of brand new apartments, so your scarcity value of your property is very low and you're competing against a lot of landlords. So you've got to think of all of those things when you're going for something brand new that will deliver you the tax benefit. So strategy is the right word. We had all kinds of strategy conversations and planning sessions to think about what we'd do next year.
I was just about to bait you and say, okay, so mate, you must have been looking for one-bedroom apartments in South Bank, but you've already sort of shut that down.
No, and I'm still a firm believer in established property because the scarcity is so vital.
Yeah.
And when you're getting very close to a CBD, when you're in a village and train station and where people want to be, you can really target some properties that can't easily be replicated. There's no more land release, and there's limited high-rise or large releases of apartments in certain areas. So I wouldn't have lost my enthusiasm, but I certainly would have been mindful of the cash flow implication for the client without having any help from the taxman. So I had to think about where I could go and target established property where the yields are high enough to be sustained by the investor.
Yeah.
And then where could I go for brand new property where I'm not breaking my own rules? And we talk about land to asset ratio, and that's a whole new segment, but if the value of the land as a proportion of the price tag is greater than 50%, that's getting a big green tick from me. There's obviously lots of other ticks that need to align, but if I could target gentrifying areas where we have, let's say, townhouses on good size allotments and they're a quality build, they're walking distance from all the things that people value, that might have been a new focus for me. So I was preparing to target some of those areas.
It's a bit weird, isn't it? I mean, because the environment was so sort of strange in that you've got the full sort of depreciation benefits for brand new, and then if you're buying brand new, then you've still got the negative gearing sort of stuff. But then if you buy brand new, the value of it for the second person is potentially less because they don't get the benefits. Yes. It would have been very sort of difficult to strategize and also predict what your average person was doing. Now that we don't need to worry about that, back to the tried and tested formula.
That's right. Yeah, we live to see another day, at least for the next 4 years. But it certainly would have been a change for a lot of buyers agents and for a lot of consumers. And also having to talk to people about how long they hold an asset for would have been a really critical conversation, because you just nailed it. Your depreciation can be very strong on something where the dwelling component is more representative than 50%, and that would have been something I'd continually try to avoid. Yeah, interesting.
Yeah, we're in conflict in the sense that that's the sort of stuff that I provide the best benefit, but we're not in the sense that that's not something that I recommend to investors. It's a little bit weird. If they buy that, I go, yay, we'll get some great deductions, but it's not so yay for potential capital growth.
No, it's all about balance and cash flow, a bit of diversification, but absolutely knowing what you're doing, because if you're going into property investment just for tax benefit, I would argue that there are better ways to invest your money.
Good way to end. Cheers.
Thanks, Mike.